This video was brought to you by Nebula. The American economy has reliably outperformed expectations for the past couple of years. Compared to other developed economies, inflation has been low while growth has been conspicuously high, despite some pretty steep interest rate hikes by the Federal Reserve. Things have been so good that when inflation fell earlier this year, commentators started eagerly talking up the prospect of a so-called soft landing, i.e. a non-recessionary decline in inflation. Unfortunately for Americans, however, in the past few months, things have been looking a bit shakier. Inflation has remained stubbornly above target, growth has come in under expectations, and the latest jobs data released on Friday was so weak that it apparently sparked fears of a recession, triggering a massive sell-off in the stock market. So in this video, we're going to try and figure out whether the US is actually on the brink of a recession, and whether there's anything the Fed can do to get things back on track. So, this story probably starts last Tuesday, when the Federal Reserve held its latest meeting, when they were due to decide whether to cut interest rates, which had been hiked to a 25-year high of 5.5%, or whether they should hold them where they are. Broadly speaking, there are two factors in the Fed's decision-making here: inflation and the perceived risk of a recession. If inflation is too high or too sticky, the Fed would more likely hold rates, because interest rate cuts could increase domestic demand and therefore inflation. Conversely, if the odds of a recession were too high, the Fed would be more likely to cut rates in order to stimulate the economy and get growth going again. The data had been a bit mixed here. While inflation did look a bit stickier than the Fed would like, refusing to fall below 3% for the past year, the odds of a recession also seemed to be rising. GDP growth came in well below expectations in the first quarter, and there was some evidence to suggest that job creation in the US economy was slowing, which would be another sign of an impending recession. In the end, the Fed decided that the risks of a recession weren't sufficiently severe to justify a rate cut, and on Wednesday announced that they would be holding rates steadily at 5.5%. In retrospect, this was probably in part because the jobs data at the time was inconsistent. While the so-called payroll survey, which samples a bunch of firms and government agencies to estimate earnings and jobs, was showing strong jobs growth, the so-called household survey, which samples, yep, you guessed it, households to estimate employment, was showing stagnant or negative jobs growth. These two measures usually match up nicely, and the fact they didn't made it more difficult for the Fed. In choosing not to cut rates, it seemed like the Fed prioritized the payroll data, and, well, that's sort of fair enough. Even though the payroll data is often revised downwards, it's generally considered to be more accurate than the household data, both because the payroll survey is recalibrated to match up with the census every year, and because the household survey suffers from a smaller sample size and deteriorating response rate. Unfortunately for the Fed, though, the actual jobs data released by the Bureau of Labor Statistics on Friday suggests that the payroll survey was too optimistic. According to Friday's data, some 114,000 jobs were created in July, significantly lower than both the 175,000 forecast by Wall Street and the 215,000 average gain over the past 12 months. Overall, the unemployment rate rose by 0.2%, from 4.1% to 4.3%. This increase in unemployment set the cat amongst the proverbial pigeons, because historically, this sort of an increase has been a reliable indicator of a recession. Specifically, the Fed has a rule of thumb known as the SAM rule, which states that when the 3-month moving average of the unemployment rate is at least 0.5 percentage points above its low over the prior 12 months, the economy is in the early stages of a recession. The SAM rule has predicted basically every recession since the 70s, and July's data means that it's just been triggered. This sparked the massive stock sell-off that we saw on Monday, when the S&P 500 saw its worst single-day loss since 2022, and the Nasdaq dropped by 3.4%. So, does this mean that the US is on the brink of a recession, or maybe already even in a recession? Well, it's not entirely clear, but there are reasons to be skeptical of this doomerism. First, even though the SAM rule has been triggered, interpreting employment data has been made more complicated by the unprecedented surge and new entrants into the US job market, mostly as a consequence of rising immigration rates. Second, other macro indicators still look pretty good. GDP growth was weaker than expected for the first quarter, but it still came in at 1.6% year on year. Similarly, while headline inflation is still higher than the Fed would like, on Monday, the New York Fed claimed that by its preferred measure of core inflation, inflation had fallen to just 2.06%, only a smidge above the Fed's 2% target. Third and finally, the declines we saw in the stock market were also a consequence of a wider anxiety among investors about what increasingly looks like an AI bubble, with stocks like Nvidia and Intel now down about 30% from their recent highs, as well as the Bank of Japan's decision to hike rates on Wednesday. Basically, because inflation has been relatively low in Japan, and Japan has a ton of debt, the Bank of Japan has kept rates static around zero. But at the same time, other central banks have been raising their rates, so the yen has been declining in value. This has tempted investors into so-called carry trades, where investors borrow cheaply in yen to buy high-yield assets, including Japanese stocks. However, as other central banks like the Fed have stopped raising rates and the Bank of Japan has started raising rates, the yen has appreciated, and this carry trade has become less viable. The BOJ's decision on Wednesday sparked a massive unwinding of these trades, and therefore a collapse in Japanese stocks, which had a knock-on effect on other markets, both because it panicked investors, and also because Japanese investors had to sell foreign assets like American stocks to meet liabilities during the turmoil. In this light, what happened in the stock market looks more like a market-specific correction rather than a symptom of a recession in the wider US economy. It's also worth saying that even if the stock market had a tough day, the S&P is still up 10% this year so far, and about 15% year to date, which is above the historical average. Nonetheless, this all still presents the Fed with a dilemma. Things do look worse than they did a week ago, and an emergency interest rate cut before the next meeting in September could help boost the economy and assuage recessionary fears. On the other hand, an emergency cut could signal panic, which could be bad news if the economy is a bit frothier than we currently realize. Now, you can keep diving deeper into this and other news stories over on Nebula, where the TLDR team curates the most important news videos from around the world, saving you from a deluge of bad news and helping you pay attention to what really matters. This means no more feeling out of touch. On Nebula News, the TLDR team act as your guide through the media landscape, sharing the news that we're paying attention to and helping you to find the stories that matter and avoid burnout. Now, if you don't know already, Nebula is a streaming service that we co-own with a bunch of your favorite creators. There, you can watch original content like Real Life Law's incredible series War Room, which every month runs you through a whole load of ongoing conflicts, keeping you in the loop. You can also watch every TLDR video on Nebula ad-free, and in many instances, before they land on YouTube. If you're not a member already, then you can click the link in the description to sign up now. And if you do, you'll get 40% off an annual plan by using our link. Plus, Nebula will know that you came from us, which really helps us out. We've got some great feedback from existing members on the Nebula News features, so I hope you enjoy the effort that we're putting into Nebula News.